Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Welcome to The Bigger Picture. I'm Dan Koh. Now, since taking office, U.S. President Trump has announced a growing list of tariffs on specific countries and commodities that's aimed to protect American interests. And while the rollout was initially marred by delays and reversals, the latest announcements have ignited an international response, sending markets on a roller coaster of volatility. Then again, the stock market has recouped its spring losses and more thanks to investor optimism that the worst effects of Trump's tariffs might be avoided. So is the potential for good news on tariffs already reflected in stock prices? Let's find out with Ray Heung, the Senior Investment Strategist at Standard Chartered Bank. Good morning, Ray. How are you doing today?
Very well, thank you.
All right, Ray.
Thank you for having me too.
Oh, it's our pleasure. Thanks for joining us this morning. Now, Trump's move to introduce tariffs has thrown the economy into chaos, and critics have argued that tariffs will make products more expensive for U.S. consumers. In fact, according to the International Monetary Fund, America is expected to be the hardest hit and says the U.S. recession is more likely this year. So can you give us an overview of the impact of the tariffs on U.S. equities so far and how investors should be digesting the mood of markets today?
Thank you for the question, Dan. I guess, the market reaction has already said it all. We initially saw the equity move in tandem with the tariff headlines. First down leg after the Liberation Day, and then rebound along the way as the trade truce with China has added in particular. I think if you look at S&P, at one point it was down about 20% from the peak, but now has recouped most of the losses and turned into a gain. Also, fund flow suggesting that some of the sell-off in U.S. assets have moved into European assets, and that flow has now reversed somewhat. This is also reflected in the DXY, and we do expect the DXY will strengthen in the near term, and the interest in U.S. asset and equities will come back, and also because of closing of the bearish spread on the U.S. dollar earlier. One thing that we would want to remind investors, though, is that don't forget that U.S. dollar is still the predominant currency. Despite that, it only represents about 25% of the global GDP, but close to 90% of FX transaction is still U.S. denominated. So we expect over the long term, U.S. dollar to be weaker, as the weakening of the so-called U.S. exceptionalism will likely translate into the rotation out of the U.S. dollar asset. But near term, we think that it will show some rebound.
All right. Yes, and unfortunately, with the value of the US dollar, usually considered a safe asset, also falling in recent months, that may add to some volatility. But of course, the optimism in stock markets, like what you've rightly mentioned, since bottoming out on April 8th, that is expected, at least according to you, to test February's record highs of 6,147. So what's the argument for funds rolling back to the US today?
I think important to note that there are a few reasons that we think that, risk asset, in particular equity, will continue to rise. Number one is that more trade deals are expected to be concluded. And secondly, there is still very resilient hard data from the U.S. economy. And then you added in Trump deregulation agenda. So also, if we look at our short-term technical model, also turn bullish in supporting this stance. And I think more importantly, we continue to emphasize the importance of ensuring adequate diversification across the region.
Right.
But in terms of the opportunities and risks in the market, I think in terms of the specifics, we now have a bit more of an overweight on the U.S. We view the Euro area and Asia, Japan equities as neutral, but we still think that they are core. And within Asia, we have an overweight stance to Chinese equity. If we look at sector that we favor, including semiconductor, I think that we are still riding on the AI theme, and sector with pricing power, such as technology, software, communication services, and financial, especially with the deregulation theme, is actually coming back.
Right.
And outside the U.S., we continue to prefer sectors with domestic exposure. I think in particular, we're talking about European banks, China non-financial SOE, which are paying high dividends, or those that have offsetting stimulus. I think in this area, European industrial and Hang Seng technology will be a good candidate. Base case for us is still a soft landing. So I think the key risk for us to monitor is still a hard landing risk.
Fantastic. Thanks a lot for that broadened perspective. Now, I'd like to stick our attention to semiconductors, which was a sector that fell victim to the Sell America trade and concerns that the negative impact of tariffs and trade tensions on demand. So while the sector's been seen as too expensive, we're still seeing shares of, NVIDIA just last night rising to about 3%, close off at $141.40, and the stock has surged nearly 24% over the past month. So what are you reading from the recent earnings updates from major US AI chip producers, and has the tariffs reshaped the global semiconductor trade dynamic?
Thanks for that. I think, as you alluded to, NVIDIA is now, I think, the largest market cap stock in the market right now.
Yeah.
But overall, simply put, we remain fairly bullish, especially if we look at the Q1 earnings seasons. The guidance from the AI chip producers has been fairly consistent if you compare that with the cloud service provider and AI developers, and all expecting an increase in capex to support AI development and related demand for AI semiconductors. And this also reinforced our belief that significant earnings growth will continue in the U.S. semiconductor chips sector. I think the consensus estimate right now is about 35% in 2025, and another 20+% in 2026. So to sum it all, I think tariff definitely has some impact to sales to China, and the restriction remains for the sales of most advanced semiconductors. But demand outside of China is still providing a very strong offset. So we don't see significant slow in the demand side.
Right. How would you value U.S. semiconductor sector today? Are they still considered unreasonably high?
In terms of the valuation, probably is on the high side, but I think overall speaking, with high growth, you demand certainly higher valuation. I think so. Those are definitely justifiable.
All right, that's a fair point. Thanks a lot for that, Ray. Now let's zoom out further and talk about the recent accusations between Washington and Beijing that each has violated the terms of last month's broad agreement, and that's threatening to undo the fragile truce, which is likely to provoke fresh worries for global markets. So how are you digesting news of a possible resurgence of global trade tensions between the two?
Yeah, I think to be realistic, to begin with, we are not really expecting the U.S. and China will reach a very quick deal on trade. Not really realistic. So in a way, we are not really surprised by the rhetoric from both sides in recent days. I think both sides are likely not be upping the tariff back to those ridiculous amount when the trade war first broke out, right? And so at the end of the day, we also need to understand that U.S. needs quality in cheap goods from China. It can't find easily good alternative in the near term. While on the China side, they would need the U.S. market for its oversized production capacity and to avoid the economy from stalling or going into a deflationary spiral. So I think Trump also has shown us in the earlier act that the Trump put is still very much in place, that will depending on the market reaction. And having said that, though, the only constant in the market is probably change, right? And so we do expect some volatility to come back. But again, we would point out that both countries came into discussion knowing that they would need to strike the deal, and they still need each other. So I think the rhetoric is probably more of a show rather than, in actuality.
All right, we'll wait and see how this develops over time, but let's shift this conversation over to the bond markets, where we're seeing reports of investors sticking to the shorter end of the fixed income market with their maturities. But interestingly, you're of the view that long-term US yields are now attractive and that the term premium is near its peak. So what's the bull case on long-term US government bonds today?
I think that's a very interesting question. Maybe let me start by answering the question on the negative side first.
Okay.
So a couple of things, right? Inflation expectation, one key factor. And probably we could argue that CPI data coming from May will start to reflect some of the recent tariff measures, right? And on top of this, we have also got fiscal concern. Budget bill is now under discussion.
Yeah.
And then you would compare the U.S. bond yield in comparison with European and Japanese long-dated government bonds, where the yields are expected to increase. So all these seems to be reducing the so-called attractiveness of the U.S. government bond. But I think the important thing to note is that we see bond yield trading near the upper bound of the recent range, which is around 4.5 to 4.6% for 10 years, for instance. We also view that investor focus has gradually shifted from concerns over fiscal imbalances into the broader economic growth outcome. And in a way, some of the strain in the hard data in the U.S. did not translate into a stronger rise in long yield. And we think that this is definitely a reflection of the worry of growth. So a base case for the U.S. is still a soft landing. And thus we think that whenever the long yield are trading near or above this so-called range that we are expecting, it's very good opportunity to add position. And therefore, we recommend that. But of course, coming Friday would be a very important data point to look at with the job report coming through. Yeah.
For sure. And also, let's not forget how, treasuries with longer maturities have been under mounting pressure as lawmakers' negotiations over tax cuts continue to stoke concerns that Trump's policies would swell deficits that's already at a historic high. But thanks for that point, Ray. Before we let you go, any advice on how investors should be positioning themselves in this current investment climate?
Overall, we have been keeping to tell investors that diversification is actually one of the main things to ride through all these volatility in the marketplace, and we still stick to it.
Yep.
But I think lately, as I recap, we have turned a little bit more positive on equity side. So I think we would be suggesting investors to continue to look for opportunity in the equity side, in particular, your sectors that we were just mentioning.
Right. Back to the markets. Thanks a lot for joining us this morning, Ray.
Thank you, Dan.
We've been in conversation with Ray Heung, the Senior Investment Strategist at Standard Chartered Bank, talking all about when it comes to US stocks, whether funds are going back into US equities today. Keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.